Well, folks, let's take a deep breath and dive into Omega Healthcare Investors Q3 2024 earnings call transcript. It's not exactly light reading, but we're here to break it down.
Yeah, we've got a bit of a mountain of material to get through the transcript, some stock info, and a few news articles to fill in the gaps.
Exactly. Our goal, to cut through the noise and give you the key takeaways so you can really understand where OHI stands.
Think of us as your guides through this dense but important document.
All right, so first things first, let's look at the financials. Omega actually beat analysts' expectations on both revenue and funds from operations. That's FFO, for those who don't speak fluent REITs.
Right. FFO is essentially a REIT's version of net income, so it's a pretty key indicator of how profitable they are. But what's really interesting is what drove this beat.
So it wasn't just a good market lifting everyone up.
Exactly. It seems to be driven by some strategic acquisitions and some smart portfolio management.
Okay, so they're not just riding the wave, they're actively steering. Now, what about the dividend? I know that's what a lot of REIT investors are really focused on.
Absolutely. And the news there is cautiously optimistic, I'd say. The CEO, Taylor Pickett, emphasized that FAD funds available for distribution is exceeding expectations. That's the cash they actually have on hand to pay those dividends.
So are they in a good position to keep paying those dividends?
It seems so. Their dividend payout ratio is currently sitting at 96%, but it's trending towards the low 90s. They seem to be prioritizing a more sustainable payout model, which is good news for long-term investors.
Makes sense. They're not just trying to lure people in with a huge dividend that they can't sustain. So playing the long game.
Exactly. Trying to balance rewarding investors today with making sure they can continue doing so down the line.
All right, now let's talk about their investment strategy. They mentioned a substantial pipeline of potential deals. Where are they putting their money these days?
Well, so far this year, they've spent over $900 million. And a big chunk of that has gone towards a pretty major move, buying out their joint venture partner in 63 care homes over in the United Kingdom.
Wow, the UK. That's a pretty big bet on a market outside their traditional US base. Why the focus on the UK, do you think?
That's the big question, isn't it? Our materials don't really give us a clear answer, but we can speculate a bit. Maybe they're seeing better valuations over there, or perhaps they see potential in the UK's aging population.
It could also be about diversifying their portfolio geographically, spreading the risk.
Exactly. And it's not just about chasing the next big thing. Pickett specifically mentioned that they've walked away from some larger deals in the US that didn't meet their standards. Discipline over FOMO, as they say.
Always a good sign. Okay, now let's talk occupancy rates. Can they get back to those pre-COVID levels everyone's hoping for?
Well, Megan Kroll, the senior VP of operations, tackled that head on. The good news is that occupancy rates are slowly but surely climbing back up.
And the bad news?
We're not quite at pre-pandemic levels yet. Kroll attributes the progress they have made, at least in part, to those staffing shortages easing up a bit.
Ah, yes, the infamous staffing shortages that have been plaguing the healthcare industry. Still a big pain point, it sounds like.
Oh, absolutely. And this ties into another big theme from the call, the whole regulatory roller coaster, particularly the drama surrounding the federal staffing mandate. It's been a real thorn in the side of skilled nursing facilities.
And Omega's operators are feeling that pressure too.
For sure. Kroll actually seemed cautiously optimistic that the mandate might be overturned, maybe through legal challenges or some legislative magic after the election.
What do you think the odds are of that actually happening?
It's hard to say. She did point to a couple glimmers of hope. There's a motion for summary judgment in Texas that could lead to a ruling early next year, plus a separate lawsuit by 20 attorneys general in Iowa. Things are heating up on the legal front.
And I remember she mentioned that the Supreme Court overturning the Chevron doctrine earlier this year could be a good sign for those challenging the mandate.
Right, that's a big one. It basically weakens the ability of federal agencies to make sweeping policy changes without clear authorization from Congress. It could chip away at the mandate's legal foundation.
So a lot of legal battles and uncertainty still on the horizon. And all of this, of course, has a ripple effect on the skilled nursing industry and Omega's portfolio.
Absolutely. Speaking of which, let's zoom in on some specific operator relationships that came up during the call, starting with Levy, who've been going through bankruptcy proceedings.
Right. Any signs of light at the end of the tunnel for them?
It seems like it. They're on track to emerge from bankruptcy with a restructured balance sheet, maybe as soon as mid-November. They've been consistently paying rent $3 million a month since June, and that's expected to continue once the plan is confirmed.
Okay, so a potential sigh of relief there for Omega. What about Maplewood? They've had their own challenges, haven't they?
Yeah, Maplewood is a bit more complex. They're not in bankruptcy, but they're still working through ownership changes and legal paperwork related to their financial restructuring. Occupancy rates are slowly getting better, but it'll be a while before they reach a stable level.
Turning around a struggling operator is like turning a giant ship. It takes time and careful maneuvering.
For sure. And on top of all that, Maplewood is also developing a new senior housing property in DC. That'll be added to Omega's portfolio once it's finally ready.
Speaking of that project, didn't they mention a slight delay? Anything to be concerned about there?
It seems pretty minor, just the usual final construction hurdles and getting the certificate of occupancy. Instead of opening in December, it's now looking like January. No major red flags there.
Good to hear. Now, beyond these specific operators, they also talked about the overall health of their tenant base, especially those with lower rent coverage ratios. What's the story there?
Well, they did mention one new operator that has dipped below that critical 1x EBITDA coverage threshold. EBITDA, by the way, stands for earnings before interest, taxes, depreciation, amortization, and rent. It basically measures a company's ability to generate cash from its operations.
So a coverage ratio below 1 means they're not bringing in enough cash to cover their rent. Definitely something to watch closely.
Agreed. However, there is a potential silver lining here. This particular operator is mostly in Florida, and Florida is expecting a pretty significant Medicaid reimbursement rate increase soon. That could be enough to push their coverage back above water.
Fingers crossed. Now, before we wrap up this first part of our deep dive, there's something that really caught my attention.
I'm all ears.
They mentioned a growing focus on loans, alongside their traditional real estate acquisitions. Sounds like they're branching out.
Yeah, it's like they're dipping their toes into a wider range of financial activities. Dan Booth, the COO, talked about all sorts of loans, mezzanine financing, loans to lease, even long-term loans with lockout provisions that essentially act like leases.
So they're not just doing those standard one-size-fits-all loans. They're getting creative and tailoring their approach. Why the shift, do you think?
It's probably a combination of things. For one, as you said, they're probably looking for higher returns. Mezzanine debt, for instance, usually comes with a higher interest rate because it's riskier.
Higher risk, higher reward, right?
Exactly. But I think it also reflects a desire to expand their influence in the industry and build stronger relationships with key operators.
So it's like they're becoming more than just a landlord. They're a financial partner for their operators.
Precisely. By offering more financing options, they can cater to a wider range of needs and attract new business. It's like saying, hey, we're not just here to collect rent, we're here to help you succeed.
And from what I remember, Dan Booth mentioned that some of these loans are being used to bring new operators into the fold.
You're absolutely right. It's about strengthening existing relationships and forging new ones.
A smart, two-pronged approach to growth. But are they being careful about it?
It seems that way. They're being selective and strategic, aligning these lending activities with their overall investment strategy.
Well, this has been a fascinating first dive into Omega's Q3 earnings call. We've covered their financials, investments, and some of the challenges and opportunities they're facing in this complex industry.
And we've only just scratched the surface. There's a lot more to unpack.
Absolutely. But before we move on to part 2 of this deep dive, I want to leave our listeners with something to ponder.
I'm intrigued. What's on your mind?
Well, given everything we've talked about, their strong financials, their active investment pipeline, their strategic approach to this tricky regulatory landscape, do you think Omega is poised to capitalize on the current market and come out even stronger?
That's a great question to chew on, and one we'll dig into further in part 2 of this deep dive. We'll analyze the potential risks and rewards and try to paint a clearer picture of what the future might hold for Omega. But for now, let's give everyone a moment to think about that question. So picking up where we left off, you asked a pretty thought-provoking question. Can Omega really leverage its strengths and navigate this choppy industry to come out on top?
Yeah, it's definitely a question on a lot of investors' minds. I mean, let's be real. They're facing some serious headwinds, just like everyone else in the skilled nursing and senior housing sectors.
True, but they do have a lot going for them. A really solid balance sheet, a portfolio they've been actively reshaping, and a disciplined approach to investing, which is always a good sign.
And that strategic move into the UK market could really pay off if that sector continues to grow the way some analysts are predicting.
Exactly. And don't forget about the potential upside if that federal staffing mandate goes away or gets a serious overhaul. That would be a game changer for skilled nursing facilities, including those in Omega's portfolio.
It's almost like they're playing this high-stakes game, juggling their financial strategy, operator relationships, and a regulatory landscape that seems to change every other day.
That's a great way to put it. Now, let's dive into some specifics, some factors that could really make or break Omega's future. We talked about occupancy rates earlier, but it's worth repeating just how crucial those are to their financial health.
Absolutely. Higher occupancy equals more revenue for their operators, which means a steadier stream of rent payments for Omega. It's pretty simple, but vital.
And remember, Megan Kroll pointed out that those occupancy rates are moving in the right direction. It might be slow and steady, but it's progress. The big question is, can they maintain that momentum, especially with the ongoing staffing challenges?
Right. She mentioned staffing as an ongoing issue, particularly in certain areas.
Yeah.
Did she say which regions or states were being hit the hardest?
Yeah, she specifically mentioned Florida and Texas as being especially tough when it comes to staffing. Not really surprising considering their large populations and competitive labor markets. She also noted that some rural areas are struggling to attract and retain qualified healthcare workers. That's a problem that goes beyond just those two states, though.
It's a nationwide problem, but it sounds like it's amplified in those particular locations. Okay, so beyond occupancy rates, what about the overall financial health of Omega's operators? I know we touched on Levy and Maplewood, but how's the bigger picture looking?
That's a really good question. There was some talk about rent coverage ratios, and I think it's important for investors to understand how those are trending across the entire portfolio.
Yeah, because ultimately Omega's revenue hinges on the ability of those operators to pay rent on time. If those coverage ratios start slipping, that's bad news for Omega.
Exactly. It's a domino effect. If the operators falter, Omega feels the impact. But here's the good news. Overall, operator EBITDA coverage has been improving. In fact, for the trailing 12 months ended June 30th, 2024, it actually reached 1.49 times.
That's pretty encouraging. Suggests that, on average, Omega's operators are generating enough cash to comfortably cover their rent. Right?
Yeah, but it's important to remember that averages can be a bit misleading. You have to look beyond the overall numbers and zoom in on how individual operators are doing, especially those with those lower coverage ratios.
Reminds me of that one operator we talked about earlier, the one that dipped below that 1 times coverage threshold.
Yeah.
The one that's primarily based in Florida.
Oh, yeah. That situation definitely warrants a closer look. While that Medicaid rate increase in Florida could be a lifeline for them, it's crucial to watch their progress closely and see if they need more support to stay afloat.
It all comes down to managing risk. Omega needs to make sure they're not too heavily reliant on any single operator or geographic area that could take a sudden hit.
Absolutely. Diversification is key, both in terms of those operator relationships and their geographic footprint. It's a fundamental principle of REIT investing.
And speaking of diversification, those investments in the UK seem like a deliberate move to spread their risk geographically. We've touched on some of the reasons for that, but are there any specific advantages or disadvantages to investing in the UK's senior care market compared to the US?
That's a fascinating question. Unfortunately, our materials don't provide all the answers, but I can share some thoughts based on what we know about industry trends.
I'm all ears.
Well, one key difference is the regulatory environment. The UK has a national healthcare system, the NHS, which plays a much bigger role in senior care than the US government does here. This creates both opportunities and challenges for private operators.
Interesting. How so?
Well, on the one hand, the NHS provides a steady stream of funding for senior care services, which can be attractive to investors looking for predictable returns. On the other hand, the NHS also sets strict standards and regulations, which can limit what operators can do and potentially impact how profitable they are.
So it's a trade-off between stability and autonomy.
Exactly. And another major factor is demographics. The UK, like many developed countries, is seeing its population age, which is driving demand for senior care services. But the pace and the specific needs of that demographic shift might be different from what we're seeing in the US.
Yeah, population trends are a big deal in this industry. It would be really interesting to compare the projected growth rates of the senior care markets in the UK versus the US to see how they stack up.
I agree, that would be a useful data point to consider. Now, beyond the regulatory and demographic stuff, there are also cultural factors that can influence how the senior care industry operates in different countries.
Oh, absolutely. Cultural attitudes towards aging, family structures, and preferences for care settings can vary quite a bit from country to country.
Right. These cultural factors influence everything from the types of senior care services that are in demand to how facilities are designed and run.
So it's not just about crunching numbers. You have to understand the people and their needs.
Couldn't have said it better myself. And that's why it's so important for investors to do their research and really understand all these factors before making any investment decisions.
Wise words. It's easy to get caught up in the hype of a new market or an exciting investment, but you have to step back and look at the bigger picture.
For sure. Now, let's shift gears a bit and go back to Omega's investment strategy beyond those real estate acquisitions, specifically their move into lending activities.
You mean their expansion into those various types of loans?
Exactly. We talked about it briefly earlier, but it's worth exploring a bit further. Dan Booth highlighted their involvement in mezzanine financing, loans to lease, and even those long-term loans that basically act like leases with their lockout provisions.
They're getting pretty creative with those financing structures.
Right.
What do you think is driving this shift? Is it just about chasing higher returns, or is there something else going on?
It's probably a combination of things. First, as you mentioned, those potentially higher returns are definitely a motivating factor. Mezzanine debt, for example, usually comes with a higher interest rate because it carries more risk.
Higher risk, higher reward, right?
Exactly. But I also think this move reflects Omega's desire to become a bigger player in the industry and solidify their relationships with key operators.
It's like they're transforming from just a landlord into a more comprehensive financial partner for their operators.
Precisely. By offering a wider range of financing options, they can meet more of their operators' needs and potentially attract new business. It's like saying, we're not just your landlord, we're here to help you thrive.
And if I remember correctly, Dan Booth mentioned that some of these loans are actually being used to bring new operators into the Omega fold.
You're absolutely right. So it's not just about strengthening existing relationships, it's also about creating new ones.
It's a smart strategy for growth, expanding their network and finding promising new partners.
Absolutely. And it seems like Omega is being very careful and deliberate about how they approach these lending activities.
So they're not just throwing money at every deal that comes their way. They're being selective and strategic.
That's what it seems like, which is reassuring for investors. It suggests they're not just chasing yield blindly. They're making calculated decisions that align with their broader investment strategy.
That's an important distinction. It's easy to get caught up in the hype of a hot market, but discipline and strategic thinking are essential for long-term success.
Well said. Now, before we move on to the final part of this deep dive, where we'll explore some additional insights and potential risks, let's pause for a moment and let our listeners absorb everything we've covered so far.
Sounds good. We've covered Omega's financial performance, their strategic investments, and the challenges and opportunities they're facing in this incredibly dynamic and ever-changing industry.
We've covered a lot of ground, but there's still more to uncover.
Welcome back to the final part of our deep dive into Omega Healthcare Investors Q3 2024 earnings call. We've looked at their financials, investments, and the overall environment they're operating in.
Yeah, we've talked about occupancy trends, looked at how healthy their operators are, and even explored those lending activities they're getting into. But, before we wrap things up, I think we should talk about some potential risks that investors should keep in mind.
Good point. No investment is completely risk-free. And it's important to acknowledge the potential downsides, even when things seem to be going well. What kind of red flags are you seeing?
Well, one area that needs close attention is that whole legal battle surrounding the federal staffing mandate. It's still up in the air. There's a chance it could be overturned or at least watered down, but it could also be upheld or even made stricter. And that would put a lot more pressure on skilled nursing facilities, which, as we know, are already struggling with staffing shortages.
Yeah, we talked about those staffing shortages being a major pain point for the industry. And that mandate could make things even worse if it sticks around.
Exactly. And remember, any problems the operators have will ultimately affect Omega. They can't collect rent if their tenants are going under.
True. Their success is tied to how well their operators are doing. It's a two-way street.
Yeah.
What else, what other risks should we be thinking about?
Well, the competitive landscape is getting tougher. Healthcare real estate is a hot market right now. There's a lot of investor interest, and that competition could drive up acquisition prices, which could squeeze Omega's profit margins.
Makes sense. More money chasing deals usually means higher prices.
Exactly. That's why it's so important for Omega to stick to their disciplined approach to underwriting. They can't afford to overpay for assets, even when the market's hot.
Discipline over FOMO.
Right, absolutely. Now let's zoom out a little further and consider those big macroeconomic factors that could affect Omega's performance.
You mean things like interest rates, inflation, that kind of thing?
Exactly. REITs are especially sensitive to interest rate changes because their borrowing costs can go up and down a lot.
Yeah, if interest rates climb, it gets more expensive for Omega to finance new acquisitions or refinance their debt. That could hurt their profitability.
And inflation, as we all know, can erode the value of real estate over time, especially if rental income doesn't keep up with rising costs.
Oof, not a good combination. So there are a lot of external forces that could affect Omega's future, some of which are completely beyond their control.
That's investing for you. There are always unknowns and risks to consider. But it's worth pointing out that Omega has a long and pretty impressive track record of navigating these kinds of challenges.
They've been around the block a few times. They've weathered economic storms, interest rate swings, and regulatory changes. They've shown they can adapt.
Exactly. That experience, along with their strong financial position, their disciplined approach to investing, and their focus on growth and diversification, makes me cautiously optimistic about their ability to handle whatever comes their way.
That's reassuring to hear. So even with those potential risks, you're still feeling positive about their long-term prospects.
I am. I think they have what it takes to succeed. But like with any investment, there are no guarantees. Investors should always do their own research and carefully weigh the risks and rewards before making any decisions.
Sound advice. So to wrap up this deep dive into Omega Healthcare Investors Q3 earnings call, what are the key takeaways for investors?
Well, the main one is that Omega is a solid, well-established REIT with a great track record and a strong financial foundation. They've consistently delivered for their investors, and they've shown they can adapt to a changing market.
And what else should investors be thinking about?
Well, they're actively pursuing growth opportunities, both in the U.S., where they're well established, and in the U.K. That geographic diversification is a smart move that could help them reduce risk and boost their long-term growth potential.
And lastly,
They're facing some challenges, like everyone else in this industry. Staffing shortages, uncertainty around regulations, and competitive pressures are all things that could affect how well they do. But their experienced management team, their disciplined approach, and their focus on strong partnerships make me think they're well equipped to deal with those challenges.
well, this deep dive has given our listeners a really solid understanding of where Omega stands and what might lie ahead. Definitely a company to keep an eye on.
I agree. Their story's far from over, and it'll be interesting to see how they navigate the ever-changing world of healthcare real estate. But for now, that concludes our deep dive.
It's been great exploring this with you. To all our listeners out there, stay curious, stay informed, and as always, happy investing.